Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report.
And good evening, everybody. Today is Tuesday, June 15th, 2021. I am Michael Hartzman, and sitting in for Dominic Tavella tonight is Jordan Kimmel, our lead equity strategist and portfolio manager at Lebenthal Global Advisors. How are you, Jordan?
I'm doing great, Mike. It's great to join you on the opening here. We missed Dom, but I'll step in for while I can, and it's great to be with you tonight.
Well, Jordan, you never had a loss for words, so I'm sure it's not going to be a problem. This evening, we have a couple of really good guests joining us. We have James Black, who's a partner at Silverman and Acampora, and actually a professor as well at Hofstra and LIU. And he's going to be talking about corporate governance, which is a really interesting topic, Jordan, as it relates to how large companies make investment decisions and how making poor investment decisions can really affect their stock price. And then you have Kevin Mahn on later, who's the president of Hennion and Walsh. So we're looking forward to the show.
Yeah, it's really interesting. I think, this subject about, the corporate governance is dear to my heart, Mike. You know that our fax model that we manage, the SMA, really goes at the most trustworthy companies. And the way to get trust is good corporate governance. And I've really explored that. And I think that more and more of the consumers out there, they want to know not only who makes it, but how is it made? So it's an increasingly important subject.
It is. And I remember a couple of years ago, I was on a conference call with the head of BlackRock, and Larry Fink, and he really made a point that BlackRock was going to consider corporate governance or lack thereof when BlackRock was going to take a position in a company. So it really is becoming more and more an important subject.
Right. And he's actually been a champion of it. And I'm looking forward to the conversation because, part and parcel is this other thing called greenwashing and governance washing, where people, they have to walk the walk, not only talk the talk. So it's interesting to see what metrics your guest has. And I certainly, dear to my heart. And so in addition to that, Mike, the markets feel like they're kind of treading water. They feel like they're meandering. There's a little action below the scenes. Tomorrow's a big Fed meeting. I think a lot of market participants, observers are really looking at that meeting as something important.
And last week I made the comment, I love when I get a chance to quote Yogi Berra. And I seem to say it's deja vu all over again because we, Dom and I feel like we say the same thing every week, but you just said that the market is meandering along. But yet, Jordan, we hit a record high again this week.
Hey, let's not forget that, it's not always this good. Frankly, I think this is a great environment. I think people think you're smarter when you talk about all the problems of the world. But there's a lot of really good things going on worldwide. And when we hit new highs on the S&P, hopefully everyone out there is participating the same way. I know our clients are, and I know we're doing it in a way that's comfortable as well.
Jordan, does it make you nervous? When we used to hit new highs, there would be a headline, right? It would be on the cover of the Daily News or the New York Post or even the New York Times, right? It would make page one. We seem to hit new highs so often now that it's not even news.
Well, let's not get bored with it. I definitely understand exactly what you're saying here, Mike. And the fact is, what you're talking about is complacency.
Yep.
And people let their guards down and forget about, I always say people forget about the crash of we could say 87 or 2000, 2006. Mike, people forgot about last March.
Exactly.
How they actually felt when their portfolio wasn't really battle tested, battle proof. And it was only last March where people, and you and Dom have talked about, a vast amount of seniors and people without advisors went to cash during the scariest time and are still trying to find their way back into the market.
Yeah, waiting to get back in, right? Which is
they're waiting for bad news. But Mike, the thing we know from 30 years of experience, people say, I'm going to wait for the pullback. When the pullback does come, the news is very scary at the time. And most people don't have the ability to tactically maneuver then. So we talked about having a plan. We're going to look at this Fed meeting tomorrow, but we know we have a plan for tomorrow, and we have a plan that goes way beyond the end of the year. It's those people that are too reactive, I think, to the messages of the day, get whipsawed a lot, and experience helps you to avoid that.
Yeah, and even tomorrow with the Fed, the media is already teeing it up that it's the meeting of the century, right? It really is. It's just another meeting. They meet 4 or 5 times a year.
Right, until the meeting ends, and then they tee you up for the next major thing to tune into.
Exactly. So Jordan, as always, these 8 minutes went flying by. We're going to take a quick break. I will see you other half of the show when we have your guest. Thanks for joining me for this segment, and we will be right back.
Are you paying federal taxes on your cash? I work hard for my money that I keep in cash. And for the life of me, I can't imagine why anyone would want to pay federal taxes on their cash. That's why I keep my cash in the Lebenthal Ultra Short Tax-Free Income Fund, symbol LETAX, le tax.
Rates on cash are already so low, why pay federal taxes on the interest your cash earns? Remember, it's not what you earn, it's what you keep. The Lebenthal Ultra Short Tax-Free Income Fund, LETAX, may help you earn more on the cash you've worked hard for and keep more after-tax dollars in your pocket. Find out more about the fund by speaking with a Lebenthal Global Advisors private wealth advisor or its sponsor at dcmadvisors.com.
For your hard-earned cash, why pay the tax when there's the tax?
Lebenthal Ultra Short Tax-Free Income Fund. It's not what you make, it's what you keep. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
All right, I'm Michael Hartzman. I'm back now with Scott Hartzman, who works in our Hauppauge office. Good evening, Scott.
Hey, Michael, how are you?
I'm all right. How are you? And
Good, thank you.
We're on with our guest, James Black, who's a partner at Silverman Acampora. James, thanks for joining us tonight.
My great pleasure. Thank you for having me.
You're quite welcome. Rather than reading your background, which would literally take the entire segment, I'm just going to jump right in and talk about what brought you to your interest in the topic of corporate governance, which clearly has become an important topic, for the investing community in America. But what brought your legal career to that road, and where do you see it going now?
I sort of found it in the foxhole, you might say.
Mm-hmm.
I was a lawyer at Computer Associates in the 1990s. And, as I say to people, yes, I was there then. And when everything sort of fell apart, the few of us that were left who were cleared of anything had to put together a compliance department. And we literally built it from scratch, saying, what do we do? What did the company do right? What did the company do wrong? We looked at best practices from other companies and worst practices from yet other companies. And having then built that model, and then since then moved on to other companies and firms, when you get it right, we just rebuild that model. And the reason to your second question of why it's becoming more and more important is that people are noticing culture. People aren't just buying a product because they like the product. They want to know what's behind the product. Where is it made? How is it made? Who is making it? As I mentioned to you when we were chatting before, let me just start real quickly the example of Nike. Nike woke up one day and through social media found out that some of the portions of its sneakers were being made by child labor in Malaysia. Had they handled that wrong, that could have been, we would all be wearing Adidas.
Mm-hmm.
But they got in front of the issue. They realized that compliance is important. They tracked it down. And more importantly, they stayed there and they fixed the problem. They went to the factory and said, we're not leaving you, but we're going to stay if you do the following things. So everybody benefited. They understood the importance of corporate governance. They understood of doing the right things in the right way. My first slide in my class is, what is governance and compliance? Doing the right things in the right ways for the right reasons.
Makes sense. Seems pretty simple, right?
Doesn't it?
Let me ask you this. So Nike discovered a problem that was systemic and ongoing, and they had to address it. I know you're not a public relations person, but do you recall what you were thinking when you heard about the explosion in the Gulf of Mexico that BP caused and all the damage that they caused? Again, I know you're a lawyer, you're not in PR, but what was your first reaction? This is what BP has to do to get out in front of this PR nightmare.
Well, as you said, they had to get out in front of it, but getting out in front of it isn't just getting out in front of it. It's things you have to do. And there are actually compliance steps that you do, and then you use your PR to say, I did them. And it's very simple. It's it's FRR, fix, remediate, retrain, report. So whatever is going on, stop it, stop the problem, remediate the problem so it doesn't happen again, retrain everybody so they know what went wrong, and then report to your regulators. It's actually a pretty simple step. And the other part of it is when you're doing an investigation, I always tell my students, think about journalism questions. Who, how, when, why? Who caused this? How did they do it, or how did they let it happen? Exactly when did it happen, which is important, sort of a side issue of data breaches, because no one knows exactly when those happen. And why did we let it happen? And again, that's then back to the remediation, is how do we make sure it never happens again? And so those are actually the functional steps you take. And then you use your PR to advertise the fact that you're taking those steps. Because if you're not taking the steps, all the PR in the world won't save you.
So let me ask you a cynical question. Do publicly traded companies, which can have their stock price impacted, take this more seriously than private companies?
They should all take it seriously.
Of course.
Now, some of them need to do that because the SEC has put in rules. Another issue here is where are the regulations? Regulations and laws pop up when industries don't regulate themselves. And the SEC, if I can just, SEC Rule 13P1 does require certain, for instance, they call that the blood diamond rule, that you have to disclose if you're doing certain things in certain countries. And there are similar rules throughout the regs that require good governance and social responsibility. So they do it because they're mandated to do it. But you're right, if they don't do it, and the word comes out that they don't do it, their stock gets hit. But their stock gets hit not only because of bad governance, but also bad sales. Because even a private company, look, a private investor, an angel investor, or an equity fund isn't going to go to management and say, "Oh, no one's buying this anymore because you're using child labor, or you have zero diversity, or your managers are all accused of the most horrific harassment." They're not going to sit for that either, because among other things, the newest generation is, Scott's generation, as they're entering the work market and the stock market, they take social responsibility really very seriously. They've done a lot of surveys, and that generation, and my kids are both in Scott's generation, they're not going to invest in a company that's not socially responsible. They're not going to work for a company that's not socially responsible. in fact, when they've done surveys, and this is, this was a little bit of a really for someone like me, I'm at the very end of the baby boomers, and I think you are too,
Yes.
was that they'll take lower salaries for a more socially responsible company because it's where they want to work, and they want to be part of the solution, and they want to be part of companies, again, doing the right things in the right way for the right reasons.
So you and I must be channeling, because I was just going to ask Scott that very question and point out that, the generation younger than us, I think, are way more mindful and have this up on the more higher on the pecking order when they're looking at a company. Would you agree with that, Scott? Do you have a question for Jim?
Oh, absolutely. Because I mean, if you go into, say, New York City, you'll see these businesses with, LGBTQI plus friendly, BLM friendly. You'll see these companies advertising right out, that they're inclusive. If you look at a company like maybe Chick-fil-A, where they have gotten some heat that they're not exactly LGBTQ friendly, people my age are making a note of that, and they're actually promoting other companies like Burger King, where they're making campaigns about it.
And it's funny because actually some companies are now getting criticized for that, because it's all about, okay, it's great, this is where you are in June, but where are you in July? And,
Exactly.
Now, again, I think there's a little bit of sour grapes there. I mean, I think the LGBTQ community, and my daughter is a member of that community, and I'm a proud ally, so I'll put that right out there, that they should be glad that it's become normalized. But by the same token, these companies should, while they're doing the right thing, they're not the heroes of this. The heroes are the people who fought prejudice back in the 70s and the 80s, and fought those fights so the next generation can have greater equality. And there's a lot of accusations of being a bandwagonism. In fact, I saw one meme today. It showed the painter, and it showed the pride flag, and then July 1, the whitewash over the pride flag. So our people, it's not just Pride Month, and whether it's BLM, Pride, whatever it is,
Mental Health Awareness Month.
Mental health awareness. It's got to go on. It's part of. I could talk about this forever too. The concept of culture. Getting your corporate culture right. There's nothing more important. And that culture includes diversity. That culture includes the concept of inclusion and acceptance and social responsibility.
You see that a lot with startup companies. Usually startup companies that are looking for seed money are very inclusive, or showing that they're, LGBT friendly. I feel like, as opposed to some of the older companies that don't really promote that they're culturally responsible with the times.
Or, gee, how about this concept of paying men and women the same thing?
Exactly.
Yeah. And I think the other balancing act that these companies have to be mindful of, again, being cynical, is, are you embracing pride for profit? Are you creating rainbow style Oreos to sell rainbow style Oreos? Or are you really not? I don't even know if they have rainbow style Oreos.
They do.
But they do.
I'm
good
sure
guess.
you've given somebody a great idea if they don't, Michael.
But my point is, are they really behind pride, or are they behind the trying to make a few dollars? And and the question is, Jim, is it okay to want to do both?
I think it's okay to do both, because my view is, okay, even if you're getting behind it, but you're doing it for somewhat cynical reasons, at least you're getting behind it. And at least you're talking the talk. Now, will you walk the walk? I'll give another weird example. We had someone come in for advice, and they were having issues because their healthcare. This was an organization. This was a not-for-profit that advocated for equal rights, primarily also again in the LGBTQ space. Their healthcare didn't cover transition surgeries, and they said, at first HR went to someone and said, we don't cover it, and the management went, how can we say that? That's the height of hypocrisy. And they had to figure out a way to do that. I guess, look, I'm not a purist when it comes to that. Let's start with doing the right thing. And if you're going to make it, you and I have always heard the old thing, you do well by doing good. Yeah, by being out there and being a vocal advocate, even if you're going to make some money off it, okay, but you're still an advocate and you're normalizing regardless of what it is. The thought, for instance, back when they finally decided that Barbie wasn't always going to be white,
Mhm.
that back in the 60s, fine, you made some more money off of it, but you also normalized something very, very, very important. I mean, you think about it, how much we don't hear about. Like now, for instance, the Tulsa massacres. I was a history major. I've read American history since I could read. I never heard about that,
Right.
and I'm pretty well read. So the fact that those things just aren't out there now, it's becoming more and more visible. And part of that, by the way, is social media. When I used to talk about some of this stuff like Nike, I used to talk about the New York Times rule, that if you read it in the New York Times, what are you going to do about it? Nobody reads the newspaper anymore unless they read it on here. So now I call it the Google rule. So if you Google your name, what's going to come up? And one other point about that too is many of the bigger companies have full-time social media monitoring staffs. And what they do is 24/7, there are people searching their company name so that when someone puts out a tweet or on Snapchat or on Instagram saying something negative about them, they almost have a PR SWAT team that can react immediately, because you can't wait till the next morning, because by the next morning, that piece of social media, be it a tweet, be it a meme, whatever, could go viral and significantly, by the time the market opens, significantly impact your market price that as soon as the market opens that morning.
You see that now a lot with airline companies. I know airline companies have been in the heat a lot with videos going viral of, the staff not treating their passengers right. Usually they're pretty quick with reacting to it, but if they're not, if you go on one of their latest posts on Instagram and any social media website, you'll see thousands of comments of people dragging them until they release a statement of, what they did was wrong.
And just to switch gears 2 seconds, I'm also hearing a lot as we come out of the pandemic, and people are sick of Zooming, and people are sick of not having face-to-face meetings. But the flip side of that is I'm also hearing a lot of positive feedback as it relates to corporations and their carbon footprint. Not having their employees jetting all over the country, not having people in cars, and how much of the carbon footprint story or meaningfulness do you think that will continue to have, as we go forward and we come out of this pandemic? And will companies actually keep people home to reduce their carbon footprint? Does it become that important?
Well, back to the doing well by doing good. They're going to keep people home because they don't want to have to pay the high rents. I have a number of clients that I spent a good number of months having sort of the following conversation with a landlord. So I know we have this lease here, and it's got a rent payment. Well, it's adorable, but it's not realistic, and we're not going to do it. and we have to work from there. And some people are very, very, some landlords were very proactive about it. And other landlords were like, I'll see you in court. And I said, well, you'll see me in court after the court's open, after the moratorium on evictions come up, after the backlog. So you can take something now, or you can try to get everything in about 3 years from now. So I think the carbon footprint will be positively impacted by people realizing, as much as people are kind of sick of this, it's also very efficient. I mean, when I worked at Computer Associates, we flew people everywhere. You had a contract to sign, you put the salesman on that plane, and he went to that headquarters, and he sat in that lobby until that got signed. It was very, kind of a 1970s thought process. That was until, by the way, they actually gave the sales team management P&L responsibility, just not, they gave them bottom line, not top line, and boy, did travel change. But I think you are going to see a tremendous drop in travel. Travel will never return to what it was. Office space will never return to what it was. Companies I'm hearing about now are talking about 3-day-a-week schedules in the office. And like one day everybody's in, and other days people can work variously. I mean, we worked from home for 3 months. I was busy every day.
Right. So were we.
Or completely optional. I know Twitter, I think, is going, if you want to come in, you can. If you want to work at home for the rest of your career here, fine.
Mm-hmm. Yeah. I mean, look, I think that will have some negative sociological impacts for people. I think people will, there's a benefit for me walking out in my office and down to talk to my partner and say, so Anthony, what do you think? And just, we're social creatures. Just exactly how many times can you talk to your cat? So that, that we have a need for that, I think. But having said that, just listening and talking to people, there is a portion of our society, and it's across, I think, all strata of age, socioeconomic, gender, and race, that have become agoraphobes, that will never leave their houses.
Right.
There's that percentage of people who are just not going to do it. They'll never feel comfortable again.
And there are a percentage of people, I think, Scott's age, who, are perfectly happy adapting and being at home. And to your point, they'll make a little less not to have to get on the Long Island Railroad, for instance. Do you agree with that, Scott?
I feel like I'm mixed on that, because I have a lot of friends that actually do want to go back to work because they do miss that social aspect of being in the office and communicating with people and going out and having fun. But at the same time, yeah, I could see a lot of people my age just working at home for the rest of their life as well. I feel like that's really mixed.
Yeah, and I think, Jim, it was interesting when we all had the shutdown. Scott was 10 feet away from me most of the time, and he would come in my office pretty much every day and say, "Why do you have pants on? Like, why did you get dressed for work?" And I just got used to, if I'm going to work, I'm not going to sit in sweatpants all day or in shorts, because it just didn't feel right to me.
I agree. Every time, there was one morning during the pandemic, I was coming downstairs and my wife was like, "You're dressed." I said, "I'm getting on a Zoom call." She said, I said, "Yeah, I'm fully dressed, shoes and all." Yeah. Because there is a little bit of that, is that we feel, and I think I think that's also a little generational.
Yes.
I have one of my daughter's very good friends just graduated from Harvard Law and he's going to start a big firm, and they allowed him to do an oral argument as a law student. And, a bunch of us watched him because we knew him. And yeah, from here up, he was in a suit and tie and everything. And afterwards, he admitted he was wearing pajama pants and socks. Well, thank God he didn't have to stand up for anything. So, yeah, I think, look, just as we adapted to business casual because the generation behind us were asking, why do we need to wear a tie? I think that's going to continue.
I agree. Jim, believe it or not, our time is up. And I really appreciate you joining us this evening and bringing a different spin to the investment community. And I think it was valuable. I think our clients and listeners will enjoy it. So thank you very much.
It has been a great pleasure. Thank you both for having me.
Have a great night, Jim. And Jordan Kimmel will be right back with Kevin Mahn right after this break. When you're thinking about where to park your cash, for over 30 years in the business, I've been a fan of funds like the Lebenthal Ultra Short Tax-Free Income Fund. It's managed for cash and designed so the interest income you receive is free from federal taxes. And who doesn't love paying less taxes?
Mike, generating interest that's free from federal taxes is appealing, but I've been in this business for a long time, and people love the potential for more income on their hard-earned cash.
Sorry, Dom. But the beauty of the fund is paying less taxes on cash.
No, my friend, it's the potential for more income.
Less taxes.
More income.
Less taxes.
More income.
Less
For
taxes.
your cash,
More income.
ask your advisor
Less
about the
taxes.
Lebenthal
More
Ultra
income.
Short Tax-Free Income
Telling you,
Fund.
less taxes.
Or find out more at dcmadvisors.com.
Well, Dom, one thing I know we agree on, it's not what you earn.
It's what you keep.
Lebenthal Ultra Short Tax-Free Income Fund. Symbol LETAX. The tax. Before investing, you should carefully consider the fund's investment objectives, risks, charges, and expenses. This and other information is in the prospectus, a copy of which may be obtained by calling 800-441-7031. Please read the prospectus carefully before you invest. Investing involves risk, including loss of principal. There is no guarantee that this or any investing strategy will be successful. An investor should consider the investment objectives, risks, charges, and expenses of the fund carefully before investing. The fund is distributed by Ultimus Fund Distributors, LLC, member FINRA. The fund may invest in municipal securities, the interest on which may be subject to federal alternative minimum tax. After the fund buys a security, the IRS may determine that a bond issued as tax-exempt should in fact be taxable. There is no affiliation between DCM Advisors, LLC and Ultimus Fund Distributors, LLC. DCM Advisors and Ultimus Fund Distributors are not affiliated with Lebenthal Financial Services, Inc. or Lebenthal Global Advisors, LLC.
And welcome back to the Lebenthal Report. I'm Jordan Kimmel. It's a pleasure to bring on Kevin Mahn. He's the president and chief investment officer at Hennion and Walsh Asset Management. And Kevin, thanks so much for joining us today.
Oh, thanks so much for having me, Jordan.
So Kevin, you guys have done a great job in getting your name out. It's a tremendous growth pattern and path that you guys are on. So congratulations for all the success so far. Lebenthal had its roots in municipal bonds, boring, safe income. Our clients like to sleep at night. So there's lots to discuss. And so, Kevin, I read your last couple notes. And, so you talk about economic cycle and, investing. So the one question I want to ask, are you coming at this as an economist or a market guy? And this is the most unusual economic cycle I've seen. So make some sense of where we kind of are and how you're advising your clients.
Sure. And I'm coming at this, Jordan, as a market strategist and portfolio manager. Although to be an effective portfolio manager, you have to have a good understanding of the economic drivers and the investment implications of those economic drivers. So the way I look at it is there are four different components to every economic cycle. You have the initial recovery that leads to an expansionary period, ultimately a slowdown, and that slowdown evolves into a recessionary period. We believe that we have officially left that initial recovery period from the onset of the COVID-19 pandemic and the devastation that took place at that point in time. Generally, recovery periods last 6 to 9 months. Expansions last multiple years, and we believe we're in a multiple year expansion right now, which affords opportunities for investors, but investors are going to have to be a lot more specific and a lot more targeted to find pockets of growth opportunities, given the heights of the equity markets right now and the stretch valuations that we're witnessing.
Right. So I love that answer. I think it's really right on. And I think that we're seeing numbers right now. Frankly, I've been in business for 30 years. I've studied the market for forever. We're seeing GDP numbers that are unheard of. We're seeing a worldwide expansion. And part of the issue is the easiest money's made when the news is terrible last March. We know most people can't even invest during those periods. But here we are today. And so cutting through the kind of the noise of what the Fed might do and this and that, you've written about some rotation trades. Let's get right into them.
Sure. There's 3 potential rotation trades that we're paying close attention to in 2021. The first being the rotation from large cap stocks to small cap stocks. And thus far, small cap stocks are outperforming large cap stocks by roughly 5%. And believe it or not, they also outperformed large cap stocks in 2020, despite not getting much media attention. And if I go back to my earlier comments, Jordan, about economic cycle investing, generally smaller cap stocks outperform larger cap stocks during periods of economic expansion when credit conditions are more accommodating. Certainly that's where we stand right now. So we think that rotation is strong and should be considered for investors looking to allocate money. The second rotation we're watching is the rotation from US stocks to international stocks, both developed markets and emerging markets. Last year, emerging markets outperformed all developed markets, including the US. Thus far this year, the US remains on top. But if I consider valuations, Jordan, you look at the current PE of the S&P 500, it's roughly 30. versus a 10-year average PE for that index of roughly 18.5, valuations are stretched. But if you look overseas, those valuations aren't as stretched. And the reopening trade that's created so many investment opportunities in the US really hasn't taken place overseas just yet. So that's another area where we're looking to allocate money in a globally diversified portfolios, not just for this year, but for the next 5 to 10 years. And the last rotation trade, which is really cementing itself thus far in 2021, is the rotation from growth to value. Growth outperformed value by 36% last year, and has been in a cycle of significant outperformance over value over the course of the past decade. Thus far this year, the tables have turned though, as value is outperforming growth by nearly 11%. And we believe that the cyclical nature of the sectors associated with value stand to benefit from an expanding economy, and also stand to benefit from the likelihood of an infrastructure spending bill being passed this summer, which would and should impact those cyclical sectors such as industrials, materials, energy, communication services, and even financials. So if I think about the two areas that resonate the most right now in those rotation trades, it's small cap and value.
You know, it's dynamic conversation. So Kevin, let's drill on this, because we are seeing prospects come in with statements, and what we've seen is this dramatic complacency, if you will, of this large cap growth that, hey, this has worked for me for the last 10 years. Why should I do anything different? People that have been in the industry for a while know that things change. And so what you're talking about, I actually believe in tremendously. I think that one of the issues is that I have personally is that this indexing that's taken place is so dramatic that it's hard to kind of break the cycle from large cap. If you do the math, and I know you guys do math over there, and you look for value itself, clearly small caps and the value play has erupted. People think that they may be too late or they missed it. You're saying there's years to come.
Absolutely years to come. And I wouldn't keep large cap out of the equation, particularly large cap value. And you know why? Genuinely value-oriented investment strategies offer attractive levels of dividend income. Right now, the dividend yield, at least on a trailing 12-month basis for the S&P 500, is around 1.4. The 10-year Treasury is only yielding 1.5. So as investors find themselves challenged to find pockets of income-oriented opportunities, and I know we're going to discuss that more later, but dividend-paying equities could find a home in those investment portfolios as well, and also take part of that value rotation that we really think is starting to cement itself right now.
Well, let's go there right now, Kevin, because I think it's important. And you know, the economy itself, Fed's meeting tomorrow, what will we do? Frankly, this zero interest rate has destroyed plans for more conservative and older investors.
Yes.
And the 60-40 plan of 40% in bonds at zero interest rates doesn't work. So I think one of our most popular, most interesting questions is saying, where can we get some yield without really taking too much risk?
Yes.
What are you advising your clients to do in that direction?
Sure. And beyond just dividend paying equities, there are two areas that we're focusing in on right now with the Smart Trust UIT side of our business here at Hennion and Walsh. One being preferred securities. For some reason, Jordan, preferred securities are often forgotten about by individual investors.
Orphans, right.
Right, when they're looking for pockets of income-oriented opportunities. And if you can build a diversified portfolio of preferred stocks and not just limit yourself to bank-issued preferred stocks, utilities issue preferreds, REITs issue preferreds. REITs are the best performing asset class thus far of 2021. So how does a REIT preferred look attractive on that basis? So we think preferreds do offer the potential of income and relatively low volatility when compared to dividend paying equities or certain other types of asset classes. The second asset class that we love, and I know you do as well at Lebenthal, is municipal bonds, or municipal bond closed-end funds for that matter. You think about the supply-demand imbalance that exists right now with all the municipal debt that's scheduled to either mature or be called, and the amount that is expected to be issued. there's not enough new supply to keep up with all of that maturing debt, call debt, plus the increase in demand for tax-free income due to the likelihood of an increase in personal income taxes. We think that creates the potential for upside price potential and very attractive tax-free equivalent income potential when you combine that combination.
Right. Well, you know what? I think that I couldn't agree with you more. People love a debate. I think that you've been spot on. What I'd like to do now, Kevin, I want to bring on Michael Hartzman. Michael has a concept he calls income for life. Again, it's very conservative firm that we're running, and clients aren't looking for the home runs and the NFTs, if you will.
Yes.
Mike, we have Kevin on. Let me turn it over to you and see what we can go.
Thanks, Jordan. Thanks, Kevin. Kevin, thanks for joining us tonight.
My pleasure, Mike.
So Kevin, I'm glad you mentioned REITs because I was actually going to ask you about REITs. I know the asset class is burning it up this year. Does that make you nervous? Our previous guest spoke about he's negotiating with landlords because tenants are just not coming back. There was a headline yesterday that a major shopping mall owner went bankrupt. So I understand the logic why REITs are hot right now. It's a great source of income. Do you worry about the asset class going forward?
I do, but we have to remember, Mike, that all REITs are not created equal, and there are many different types of REITs, whether they're residential REITs, retail REITs, self-storage REITs, healthcare REITs. So there are opportunities that I see away from commercial REITs, even mortgage REITs in this environment, given the cost of carry trade. But if you consider healthcare REITs with our aging population right now and the overwhelming demand for assisted care facilities and the relative low supply, and you look at self-storage REITs, again, for our aging population, me included, who's looking to store a lot of my goods so that I can downsize once both of my kids have graduated from college. That's not a passing fad. That's a theme that's going to stay in place for years to come. So certain areas of the REIT market, I think right now have a set of risks that investors should consider. But REITs as a whole in a diversified portfolio, especially an income-oriented portfolio, are worthy of consideration.
So for the benefit of our clients, and you did mention there are different types of REITs.
Yeah.
Is there a certain type of REIT, whether it's a closed end, which might use leverage, versus an open-ended REIT, or just actually buying the stock like assignment property? Is there a certain type of REIT that you feel would give our clients the maximum amount of income with the least amount of risk?
Sure. And I'm not going to recommend a specific ETF on the show today, but there are several ETFs that invest in a diversified portfolio of REITs covering those various categories that can be managed and not just necessarily purely indexed. That could be an attractive way for investors to get involved in the REIT asset class. If I think about municipal bonds, once again, I know I said closed-end funds earlier. I'm the biggest proponent of individual investment grade municipal bonds from a downside protection standpoint, and also in terms of predictable streams of income. But if you consider municipal closed-end funds, leveraged municipal closed-end funds, recognize that 90% of all closed-end funds employ some form of leverage. In this yield environment, when those closed-end fund managers are borrowing at short-term rates and reinvesting at intermediate to long-term rate, that cost of carry differential is adding to the yield and creating a yield enhancement that's pretty attractive, at least over the course of the next 2 years, unless the Fed starts raising rates, which they've adamantly told us that they don't plan on doing, at least for the next couple of years.
Thank you.
Right. So you know, Kevin, what you really kind of talked about in those questions and answers is that people love to talk about the market. How does the market look?
Right.
I hear you digging into QSIP numbers of municipal bonds, which is, you know, lovely to hear. People that look at individual securities, and I know when you create UITs and you create different strategies, it's easy to talk about the market with one paintbrush. We know there's a whole lot underneath it, and maybe you kind of want to talk about a little bit of your team and how they go about things.
Sure. So at Hennion and Walsh, obviously we build proprietary investment portfolios for our clients to help them meet their income and growth objectives through Smart Trust. We're one of the top 5 providers of UITs, or unit investment trusts, in the country, with 25 different investment strategies. With myself and my research team and outside team of portfolio consultants and licensed index providers, we provide a wide array of different investment strategies, incorporating stocks, ADRs, MLPs, REITs, closed-end funds, and exchange-traded funds together as we select to help provide and meet those growth and income objectives. And some of our most popular strategies over the course of the past 2 years, some of which probably wouldn't surprise you as they're associated with the stay-at-home trade, if you will, like our e-commerce ecosystem trust or our new American economy trust. But even a thematic strategy like sustainable impact investing is really catching on with retail right now, and financial advisors are gravitating to it, not only because of its growth potential, but now clients can feel good about the companies they invest in and also feel good about the potential return that the stocks of those companies generate. And then we have our tax-free income trust, which invests in a diversified portfolio of municipal closed-end funds. So that's the way we approach it here at Hennion and Walsh, both through our Smart Trust UITs, which are sold through financial advisors, and then our customized portfolios, whether they contain municipal bonds or our growth portfolios of exchange traded funds for individual investors.
Right. All right. Well, Kevin, I want to say thanks so much for joining us. There's a broad array. It's all about, for us, it's about being fiduciary. It's about doing what's right for the client at all times. And we certainly appreciate your time, your insight. And we're going to be back with more Lebenthal Report right after this quick break.
Thank you, Kevin.
Thank you.
Financial planning and security can sometimes be seen as a moving target. The rules change constantly, and you need guidance to stay ahead of the market moves. This is the Lebenthal Report with Michael Hartzman and Dominic Tavella. We'll break down the news, trends, and overall direction of the markets. Now, back to the Lebenthal Report.
All right, I'm Michael Hartzman, back both with Jordan Kimmel and Scott Hartzman. And I guess, guys, Dominic would be proud that it took 2 of you guys to replace him this evening.
And we couldn't even do it between 2 of us.
Exactly.
But hey, let me just say, for full disclosure, because it hasn't been said, Scott is Michael's son. And I'm very proud of the firm itself having so many second generation employees working there. And Scott, let me just ask you, we our first guest talked about social responsible investing. The second guest brought it up as one of his more attractive new offerings. We believe the future is in the next generation. And so tell us, what it is that you like to see the most when you're thinking about investing.
That's a good question. Most in what? Is socially responsible?
Well, in terms of the fact that I've sat with you, you want profitable companies, you want names with good products, but I've also heard you talk about the fact that you want things done in a certain way.
Yeah, I mean, when it comes down to when I'm investing, I'm not honestly looking too much in socially responsible, which is, I know is bad. At the end of the day, I'm looking at to see who's all right. So I guess I could say Tesla is a good example, because Tesla is a socially responsible, as much as they say, company, in regards to electronic vehicle cars. Yeah, I mean, I guess a company that's not destroying the world, see some companies, I'm not going to say the names because I go through a list, but I would say a climate friendly company is a company that I would be willing to invest in. So I mean, that's the
Well, let me bring something out if I can, Mike. I'm going to jump right in, because when I first met Mike and Dom, and I talked about facts, I talked about the most trustworthy companies. What I heard is what we're most interested at Lebenthal is our clients' retirement plans. And not so much whether companies are saying they're socially responsible or checking certain boxes. What I heard from Michael and Dominic was we're fiduciaries looking for our clients' retirement. So you saying that you don't put socially responsible first is actually fine. We believe in Michael talked about it in his question earlier with James. Isn't it okay to really insist on both?
Right,
Doing it right and making money for clients?
right. And Jordan, to your credit, the first time Dom and I met you, we sat outside this little French cafe eating baguettes and cheese. And you were talking about part of your fact-based investing was, as Scott mentioned, companies that are not destroying the earth, right? What a simple concept.
Right. But you know what's interesting is that, and I'm okay with it, we have 4 different strategies on managing. The one that I think clients are most interested in pays 4.5%, pays an increasing dividend, and has lower risk than the market. And again, they're not asking, how socially responsible 4.5% is. They want to know that in a 0 or 1% interest rate environment, they could get both growth and income and feel good about what they're doing.
Yeah, and I also think, Jordan and Scott, in the year 2021, investors assume that companies are trying to do the right thing, unlike a few decades ago. So on that note, I promised our engineer we would close on time tonight. We went over last week. So guys, I can't thank you both enough for joining us this evening. The hour went fast as always. And Dom and I will be back next week. And I will see you guys soon.
Thanks so much for
Good
having
night.
us on.
All right. Have a good night, everyone. Thanks for joining us.
Thanks for tuning in to the Lebenthal Report. Dominic, Michael, and Jordan will be back for our next program, airing next Tuesday at 2 p.m. Pacific Time and 5 p.m. Eastern Time on the Voice America Business Channel. Until then, have a great week.